Before we start our presentation, let's start introducing our group member. Firstly, my name is Amrina Rusyada binti Armhadi.
My name is Nurul Syamimi Aliyah binti Ahmad Sukri.
Hi, my name is Norizati binti Zunaidi.
My name is Alias Sofia binti Alias.
First, we start with what is money laundering. Money laundering can be defined as a process of converting cash, funds, or property derived from criminal activities to give it a legitimate appearance. It is a process to clean the dirty money in order to disguise its criminal origin. Both white-collar and street-level criminals use money laundering, which is known as a serious financial crime. Typically, there are three stages involved in the money laundering processes, which are placement, layering, and integration. Placement involves the physical disposal of the cash proceeds derived from the illegal activities into the local or international financial systems, while layering is the separation of the illicit proceeds from their original sources through the creation of complex layers of financial transactions to disguise the audit trail and provide anonymity. And the last one is integration. The final stage is where criminally derived wealth is converted into legitimate funds with no probable links to criminal activities. In 2001, Malaysia has passed the Anti-Money Laundering Act. Then, the Act was amended in 2003 to bring terrorism financing within the ambit of the Anti-Money Laundering regulatory regime. It is called as Anti-Money Laundering and Anti-Terrorism Financing Act 2001. It criminalized money laundering and terrorism financing and introduced mechanisms for investigation and financial intelligence. Additionally, the law stipulates measures for freezing, seizure, or forfeiture of property related or to obtain from money laundering or terrorism financing activities. More crucially, it is also imposes various preventive measures to be undertaken by regulated institutions, which comprise banks and non-bank financial institutions. Next is the study reviews some factors for occurring money laundering. The first factor is ethics and morality, whereas lack of moral sense is a reason for occurring money laundering. Moreover, a lack of ethical practice in life is a cause for conducting the money laundering. The next factor is education and training, where there is a lack of awareness and no adequate training opportunities to control the offense is a factor for occurring money laundering. Furthermore, money laundering occurs because of not having financial and investment knowledge. The next factor is the bribe and speed money, where the money laundering occurs to hide the source of the bribe and speed money. Besides, money laundering also happens to pay bribes and speed money. And the last factor is tax evasion. In order to evade tax, having a higher tax rate causes money laundering. Moreover, it is also to evading import duty for having a higher rate for specific items like gold is a reason for occurring money laundering.
Hi, my name is Norizati binti Zunaidi, and now I will present our case study. The first case study, using the fintech platform to launder money. Fintech has increased the range of financial services that are now available to customers in recent years, enabling the development of new financing platforms and exchange services among ever larger populations. The fintech sector expanding and no longer insignificant relevance, necessity, and analysis of the hazard involved, particularly with regard to money laundering. The findings of laundering cases in the fintech industry. Dancebank laundering scandal. Investigation had been made into Dancebank have led to various stops regarding the transactions in question. It was conducted between 2007 and 2015 through the bank's branch in Estonia. Considering that the overall value of this transaction is close to 200 million euros, it is regarded as the largest international money laundering scam ever conducted. Even today, the primary way of identifying cases of money laundering is still a manual or human-led check. However, this procedure is time-consuming and ineffective. Analysts are in charge of assessing reported instances of financial fraud, which frequently involve false positives. However, they occasionally fail to identify a case of money laundering. Artificial intelligence-based fintech solution can help by augmenting analysts' manual work and assisting with the analysis of money laundering cases. For instance, predictive algorithm can develop a risk estimate, identify abnormalities in consumers' behavior, and create a ranking system that enables analysts to concentrate more on the highest ranked suspicious instances. For instance, the HSBC Bank has introduced a new anti-money laundering system that uses artificial intelligence (AI) to automatically identify transactions that could be used to conceal financial laundering. To identify and stop financial fraud in international trade, it made use of large database, sophisticated analysis, and a contextual automated surveillance strategy. The network are analyzed using a contextual method, which enable the bank to spot questionable trends and probable criminal networks. In order to provide business with a network intelligence architecture, it employs 40 billion financial transactions and billions of data points. This method makes it possible to continuously rate and assess the risks associated with consumer behavior. Additionally, it enhances the decision-making and accuracy in terms of both prevention and detection.
In this second case study, we want to know whether the loophole of the banking system can influence the activities of money laundering in banking institutions. Banking institutions are the most frequently used instrument by money launderers due to several factors, including multiple service provided by financial institutions, including deposit, loan, and foreign exchange. It is due to the loophole in the banking system that help criminals to hide the money either by placement, layering, or integration. With the help of banking, whether it is international or not, criminals can move this illegal money whether through a method of transferring account or fund that will not leave any trace of origin of the money. The fact that banking institutions are very vulnerable to money laundering is a very big problem to the financial sector. It should not be underestimated, especially in pandemic COVID-19, as the rise of digital banking service among citizens. In the last few years, money laundering activities has been rapidly increased globally due to the loosening of restrictions about market around the world and the removal of regulation regarding exchange control, which led to the opening of more channels or methods for laundering illegal money and giving more opportunity to launderers. In Malaysia, money laundering activity also can be referred to as white-collar crime because more advanced with their method due to appearance of information and communication of these age technologies. It made it very difficult for Malaysian police force to identify the profile of the criminal as anyone with the knowledge of computer involving with the such crime. There are several cases regarding this issue. In a new report by AD Chua, it was stated that about 35 million ringgit in dirty money via money laundering activities goes out of the country on weekly basis, mainly through the loophole in the banking system. And in the new offering Malaysia Today by Bernama, a businesswoman was charged with RM 2,040,000 money laundering offence. Meanwhile, on the new of Dayak Daily, the man lost RM 22,000 in the 15 minutes without receiving notification from the bank on 28 May. In this case, the victim found out that his money was lost and his personal records such as contact number and others have been changed. One of the impacts from issuing of the money laundering is the loss of revenue. It is due to money laundering make the government revenue to reduce as it reduces the tax revenue. Secondly, is economic distortion and investment instability. Money laundering actually can affect the growth of the economy as it also will invite the increase of the crime. It is to the illegal money will lead to the unstable demand for the money. The solution taken is implementation of an anti-money laundering (AML) becoming important within banking institutions. This policy and procedures easy to help in countermeasure the money laundering by stopping criminals from making transactions that cover out the origin of the money that are related to illegal activity. It also allows the financial institution to reduce the laundering money activity as it ensures the bank to operate in a safe and sound manner.
Next, let's continue with our third case study, which is the use of digital currency in laundering money. Let's start with the introductions. So, digital currency is a medium of trade that is created, stored, and transferred digitally. Unlike the coins and notes of traditional currencies, digital currencies are not normally linked to any nation's government or represented in a tangible ways. The most common word that people heard when it comes to digital currency was cryptocurrency. In order to protect the operations involved in creating units and carrying out transactions, cryptocurrency rely on encryptions. They are accepted by more and more merchants and utilized for purchases both offline and online in a manner similar to traditional money. Let's move to the problem statements of this study. Digital currency become the perfect tool for money laundering because they enable international transfer without relying on the transmitter service of conventional financial institutions. It usually privately held online payment methods that enable cross-border transactions and are frequently valued in accordance with the weights of gold and other precious metals. Digital currency allow account users to electronically manipulate funds similarly to traditional types of funds transfer services, with anonymity being marketed as a benefit of the sector. Money laundering is more likely to happen because a person may create a false e-commerce site that accepts digital currency payments, close the site after receiving payments, and access the funds in any country they choose without leaving even the tiniest sign of transaction. There is an increasing number of cases related to money laundering in a digital currency. According to the recent study, the use of cryptocurrency for money laundering is spreading quickly around the globe. Let's take one example. In UK, a Swedish man named Roger Nils Jonas Carlsson was sentenced to 15 years in prison for counts of security fraud, wire fraud, and money laundering after he used an investment scheme to cheat thousands of victims out of more than $60 million according to the US Department of Justice. Carlson used cryptocurrency like Bitcoin and other online payment systems to entice victims to buy shares in an investment scheme with the promises of enormous return. After transferring the money to his own bank account, Carlson spent the money on pricey houses, a racehorse, and a resort in Thailand. Next, these issues happen due to some factors. First one is the lack of legislations. Due to the lack of widespread protections and development, they are appealing to the cybercriminals as a useful tool for removing unlawful gains. Second is due to the pseudonymy or anonymity. The comparatively anonymous nature of Bitcoin transactions facilitates numerous money laundering activities. Numerous cryptocurrency exchange and wallet issuers offer their service with little no to anti-money laundering, which is AML, or Know Your Customer, which is KYC regulations in place. Lastly, I will explain about the solutions regarding these issues. Governments all over the globe have developed a variety of tactics and legal regulations to manage the risk connected with and created by digital currency as a result of its rapid developments, expanding use, global nature, and increasing functionality. The Central Bank of Malaysia published its Anti-Money Laundering and Counter-Financing of Terrorism on Digital Currency Sector 6, also known as AML or CFT Sector 6, regulations of February 27, 2018 in response to the international demand.
Last but not least, we come to the end of the presentation. So for the conclusion of these issues, we can conclude that the money laundering is essential for criminal organizations that wish to use illegally obtained money effectively. These specific hazards, such as identified theft and online extortion, are growing in the age of the digital economy. There are also several ways for criminals to maintain their anonymity, allowing them to launder the proceeds of more conventional crimes or to create sync funds for illicit purposes like sponsoring terrorism and corruption. To combine the goal of preventing criminal conduct with the incentive for innovation and efficiency in favor of end users, clear fundamental norms and regulation and also efficient law enforcement are required. In addition, money laundering is one of the biggest threats in the banking institution, since the first one will be contracted by money launderers when they are trying to move money from the illegal activities. It also means that the banking institution can be very influenced by money laundering. Therefore, it is very important to reinforce AML policies and procedures. Impactly, the crimes in the country can be reduced without the money laundering activities. The criminal will not have any channel to launder their money, and they also cannot claim the money, especially when the money can be traced back to the illegal activities. So that's all from us. Thank you.